Good morning, everyone. Welcome to Consortia Small Business Accountants Increased Cash Flow, the Statement of Cash Flows. By way of introduction, this session introduces the Statement of Cash Flows. Consortia Small Business Accountants believe it's important for small business owners to have a basic understanding of their Statement of Cash Flows, since many of their business decisions are based on their cash flows. To assess your company's financial health, you should understand your statement of cash flows. The statement of cash flows reveals how cash flows through your business, including operations, investments, and financing activities. The statement of cash flows highlights liquidity, showing whether your company can generate enough cash to sustain itself, invest in growth, and meet its financial obligations. Understanding cash flows. The statement of cash flows communicates actual cash movements or flows, providing a clear picture of your company's liquidity and financial lifeblood. It complements your balance sheet by communicating changes in your cash accounts and your income statement by communicating non-cash transactions in your income and expense accounts. By analyzing these activities, small business owners can identify trends, detect potential cash flow issues, and make informed decisions. Components of the statement of cash flows. The statement of cash flows has three main sections. 1. Operating activities. 2. Investing activities. And 3. Financing activities. Each segment provides a detailed breakdown of how cash is generated and used within your company over the stated period. Operating activities. This section of your statement of cash flows communicates your cash flows from your company's business operations. It communicates your business operations net cash increase or decrease over a stated period. A net cash increase indicates your business operations are funding your operations. A net cash decrease indicates your business operations are not funding your operations. Operating cash flows come from your operating revenue, interest, and dividends. Operating cash flows go to your operating expenses. Investing activities. This section of your statement of cash flows communicates your cash flows from your company's long-term investments. It communicates your long-term investments net cash increase or decrease over a stated period. Investing cash flows come from selling assets or collecting payments on loans. Cash outflows include capital expenditures or CapEx, buildings, technology, or equipment, investments in securities, and business acquisitions. High capital expenditures can indicate expansion, but excessive spending without strong operating cash flow may strain liquidity. Frequent asset scale sales to generate cash might warn of financial distress. Financing activities. This section of your statement of cash flows communicates your cash flows from your company's debt and equity financing. It communicates your debt and equity financing net cash increase or decrease over a stated period. Cash inflows come from issuing stock or borrowing. Cash outflows go to loan payments, dividend payments, and stock buybacks. Raising cash through financing can support expansion, but excessive debt without offsetting revenue growth may pose risk. On the other hand, consistent dividends and stock buybacks signal financial strength and a commitment to shareholder value. Net cash flow formula. So the formula then, again, keeping in mind this covers a period. Now, in this particular case, net cash flow for the year ended December 31st, 25. So for the entire year, from the beginning of the year to the end of the year, net cash flow, taking inflows, netting against outflows from operating activities, would either be net increase or net decrease. And so then we would plus it or minus it against net cash flow from investing activities. Again, the inflows from investing activities compared to the outflows of activities either is either a net increase or a net decrease. And net cash flow from financing activity inflows, net of outflows is either positive or negative, or in other words, an increase for the year or a decrease for the year. So overall, you take the increases from each of these activities, operating, investing, and financing, and overall, you know your net cash flow for the year. In a normal, healthy, high-performance business, most of your net increase for the year comes, of course, from operations, your main core of being in business. If you have investing activities, it wouldn't be unusual for that to be a decrease. From financing activities, it wouldn't be unusual for that to be a decrease. But overall, there should be a positive net increase for the overall entire year. And again, the strength of that cash flow coming from operations. Statement of cash flows formula. So we talked about how we calculate net cash flow for the year, but now we're going to talk about the entire statement of cash flow, how it works. So once again, we take the net cash flow from operating activities plus or minus net cash flow from investing activities plus or minus net cash flow from financing activities, which gives us the net cash flow for the entire year as we previously discussed. But here we now add the cash at the beginning of the year equals the cash at the end of the year. So if I were looking at your statement of cash flows, and I could see at the beginning of the year, cash was this much. At the end of the year, cash was this much. Now, I could also go to my balance sheet. And my balance sheet, as you know, is listed in the order of liquidity. And so cash is always the first thing listed because it's obviously the most liquid asset that you have. And so if I were to look at my balance sheet as of December 31st, 24, and looked at that balance, and I compared it to the year ended December 31st, 2025, you would find that the same numbers are on the cash at the beginning of the period. So in other words, as of December 31st, my cash is this much, which would also mean that on the beginning of the year, January 1st of 25, it's the same amount. And so at the end of the year, January 31st, 25, my cash at the end of the period. So the financial statements, balance sheet, income statement, statement of cash flows, statement of changes in owner's equity, all relate to one another. Yet, in and of itself, each one of them tells you specific things that you need to know and isolate. Assessing business cash flows. Your statement of cash flows assists in analyzing your company's financial health. It ensures you that cash is being managed efficiently and effectively, and it identifies potential risks and opportunities. Analyzing your operating, investing, and financial cash flows, you can make informed decisions, better understand your business sustainability, and detect trends that may affect long-term business performance. Statement of cash flows benefits. It basically does four things. Number one, it tracks cash movement or flows, complements other financial statements, assesses liquidity and solvency, and aids in financial planning. So let's talk about each one. So as far as tracking movements or flows, the statement of cash flows summarizes the cash flowing into, that is your inflows, and out of, your outflows of your business. It complements other financial statements. While your balance sheet presents assets, liabilities, and equity, and your income statement presents your profitability, the statement of cash flows provides a more complete picture by focusing specifically on the actual flow of cash, reconciling the differences between the income statement's net income and the statement of cash flow's cash flow from operations. Assessing liquidity and solvency. The statement of cash flows enables owners, managers, lenders, and investors to gauge the company's ability to meet its short-term financial obligations and avoid bankruptcy. It aids in financial planning. The statement of cash flows provide insights into a company's ability to generate cash, allowing for better resource management, budgeting, and future planning. It informs investment decisions. Investors often use the statement of cash flows to assess a company's financial performance and make informed decisions whether to invest or not. Now, again, if you're looking for ways to always increase cash, if you look at the three activities and the cash at the beginning of the year and the cash at the end of the period, obviously, as you assess each line item, let's say, for example, net cash flow from operating activities. So we want to increase cash flow, and we, of course, would prefer not to decrease cash flow. So we look for areas of what is taken away. In other words, the overall outflows. How can we decrease those outflows? And how can we increase the inflows? As far as net cash flow from investing activities, once again, how can we increase cash flow, the inflows? And how can we decrease the cash outflows? And as far as net cash flow from financing activities, how can we increase the cash flow? How can we decrease the cash outflow? So you would look at each of those activities and see how you're able to increase cash into your organization. Plus the cash at the beginning of the year, less the cash at the end of the period. And of course, those are just stated, whereas you do have flexibility within each of the activities. So that pretty much presents to you the statement of cash flows. Just a brief introduction to give you the 30,000-foot view of overall what the statement is for and why it's important. In our next video, we'll talk specifically about the statement of owner's equity, how we increase owner's equity. Have yourselves a wonderful day.